Welcome back to the Global Ledger. I'm Justin. Every global financial crisis from 2008 to COVID has had one thing in common, and that is a desperate system-wide scramble for US dollars. When that scramble begins, funding markets crack, liquidity vanishes, and the entire global economy can slip toward collapse within days. And in those moments, there is only one institution the world turns to, not by choice, but by design, and that is the Federal Reserve. Today, we're pulling back the curtain on how and why that happens. Let's get into it. Whether people like it or not, the global economy runs on dollars. More than 80% of global trade invoices are in dollars. Most commodities are priced in dollars. International banks borrow and lend in dollars. Corporations around the world issue dollar bonds. But here's the key. A lot of this dollar activity happens outside the United States. This is the Eurodollar system, and we've talked about this in previous episodes. Offshore dollar markets created by global banks. And because these banks aren't U.S. institutions, they don't have direct access to the Fed. So what happens when offshore institutions suddenly need dollars? They go to markets. They borrow short to fund long. They rely on repo. They rely on FX swaps. They rely on dealer balance sheets. And when stress hits, dollar funding evaporates. This is where the Fed steps in. Not by choice, but because the world is structured around a single funding currency. Every major global crisis has involved a shortage of dollars. 2008, 2011 Eurozone crisis, 2019 repo spike, 2020 COVID funding freeze, UK crisis spillovers, emerging market squeezes. Why is this? Because global banks borrow in dollars, but don't have the safety net US banks do. So when markets panic, the scramble for dollars begins. Repo haircuts rise. FX swap basis blows out. Funding spreads widen. Dealers start to pull back. And banks hoard liquidity. And when the private market can't make markets, only one institution can. And that's the Federal Reserve. I'm going to reference a long PDF that I downloaded directly from the Fed's website, and I'm going to reference some things in there that are important to this conversation. So the Fed has 5 key functions, but only really 2 matter for today. Number 1, promoting financial stability. Number 2, fostering payment and settlement system efficiency. So according to their document, the Fed seeks to minimize and contain systemic risks through active monitoring and engagement in the U.S. and abroad. It's directly from their PDF. So let's look at that last phrase. And abroad is the whole ballgame. If the global dollar funding system breaks, U.S. banks break, U.S. markets break, U.S. credit breaks, U.S. employment breaks. So the Fed must act not as an American institution, but as the central bank of the global dollar system. So this brings us into what swap lines actually are. Swap lines are not bailouts. They are not gifts. They are not loans to foreign governments. They are temporary currency exchanges between central banks. So mechanically, the Fed provides foreign central bank X with dollars. That central bank provides the Fed an equivalent amount of its own currency. The exchange rate is locked. The foreign central bank lends those dollars to its own banks, right? And then at maturity, everything reverses and the Fed earns interest. So this is virtually, well, risk-free for the Fed. Swap lines allow foreign central banks to act as dollar dealers of last resorts to their own banks. The Fed extends the hierarchy outward using other central banks as, say, nodes. It's the global extension of the domestic discount window, you could say. So why the Fed must do it? Why? I mean, this is there's some core truth here. So swap lines are not charity, and they're not a free handout. They're purely self-defense. And the reason this is because global dollar markets are inseparable from U.S. markets. European banks fund U.S. companies. Japanese banks buy U.S. treasuries. UK dealers run massive derivative books. Emerging market corporates issue dollar debt. Cross-border repo is enormous. So if dollar funding collapses anywhere, it collapses everywhere, including inside the U.S. So back to that PDF, they emphasize this. They say the Fed must promote the stability of the financial system and contain systemic risks. So a global dollar shortage is systemic risk. And swap lines are the firewall of this. So let's look at some of these swap lines in action. So 2008, a global dollar margin call. The interbank market froze. European banks couldn't roll their dollar funding. FX swaps collapsed. These swap lines reopened, and crises eased. The 2011 Eurozone crisis. Dollar funding dried up again. Swap lines reactivated. Stress reduced. Right? 2020 COVID crisis. Everything broke simultaneously. The Fed responded with unlimited swap lines for major central banks, temporary lines for 9 emerging markets, and then the FEMA repo facility. And we'll talk about those in another episode. But the point is, that global panic subsided almost instantly. Swap lines really work. Why do they matter to us, though? Swap lines affect interest rates. They affect risk premiums. They affect global valuation levels, treasury demand, FX stability, mortgage rates, credit spreads, emerging markets, on and on. They are the invisible structure supporting global liquidity. And we are headed toward more automatic swap lines, more permanent facilities, broader access, a de facto global dollar central bank, you could say. So the global dollar system already exists. Swap lines are becoming its official plumbing, you could say. So that's episode 29 of the Global Ledger. We uncovered briefly how swap lines work, why they exist, and why the Federal Reserve has become the world's backstop. Next time, we go to the foundation of the global collateral system. In episode 30, we're going to talk about the U.S. Treasury market. This is the world's balance sheet. Once again, I'm Justin, and thanks for being here.